Welcome back to the Daily Earnings Reports podcast. Don't forget to like and subscribe wherever you're tuning in from. Today, we're diving deep into Procter & Gamble's
P&G.
P&G
Yeah.
second quarter earnings for fiscal year 2025. On the surface, things look pretty good. Sales are up, earnings are up. The CEO's talking about, acceleration and being on track.
Right.
But is there more to the story? Are there cracks beneath this seemingly polished facade?
Well, that's what we're here to uncover. It's easy to get caught up in those big headline numbers.
Yeah.
But the real insights, I think, are often hidden in the details.
All right, let's get into it. The report highlights net sales up 2% to $21.9 billion organic sales, which strip out currency effects and acquisitions, are up 3%. So, yeah, growth is there. But for a company the size of P&G is really impressive.
Well, context is key. A 3% organic sales bump for a behemoth like P&G.
Yeah.
It isn't exactly setting the world on fire. It's decent, especially in the current economic climate.
Mm-hmm.
But it certainly raises the question, where is this growth coming from and is it sustainable?
And then there's the EPS. Diluted EPS is up a whopping 34% to $1.88 per share.
Wow.
But, as the report notes, that's partially due to a large one-time impairment charge related to Gillette last year.
Right.
Mm-hmm.
Yeah, the more telling figure, I think, is the core EPS,
Right.
which strips out these one-time items and gives a clearer picture of ongoing profitability. And that's up a more modest 2%.
Okay.
So, they're managing expectations. They know that investors are looking for that sustainable growth,
Right.
not just a temporary bump from accounting adjustments.
Okay, so the headline numbers are a bit of a mixed bag, some
Yeah.
decent growth, but not exactly knocking it out of the park.
Right.
To really understand what's going on, we need to break things down by segment.
Absolutely.
Oh.
This is where we start to see the nuances, the trends, the potential warning signs.
Let's start with beauty, always a key area for P&G. Organic sales are up 2%, but digging deeper, we see this growth is mainly fueled by hair care, particularly premium products.
Yeah.
Meanwhile, skincare is actually down.
Hmm.
What's your take on that?
Well, the decline in skincare, combined with the growth in premium hair care, paints an interesting picture, I think,
Yeah.
of a consumer who is becoming more selective, perhaps even discerning. They're prioritizing, I think, affordable indulgence over broad skincare routines,
Right.
possibly a reflection of, that economic uncertainty.
Interesting. So even within beauty, there are winners and losers.
Yeah.
And that tells us something about consumer behavior.
Right.
What about grooming? They also saw a 2% uptick.
Okay.
But there's this mention of unfavorable geographic mix.
Mhm.
What does that even mean?
Basically, that means sales performance varies by region.
Okay.
It suggests certain geographic areas are lagging behind.
Got it.
Maybe Asia is booming, but Europe is struggling. This makes the overall 2% growth less impressive
Yeah.
as it masks potential weakness in certain markets.
Okay, so we can't just look at the aggregate growth numbers.
Right.
We need to understand the regional dynamics at play.
Mhm.
What's the story with healthcare? A solid 3% growth there, with both oral care and personal health
Yeah.
doing well.
Right.
Are these just recession-proof categories?
I think there's definitely an element of that. People always need toothpaste
Yeah.
and basic healthcare products regardless of the economic climate. But it's not just about necessity. Innovation plays a role too. P&G has been successful in launching new products and premium offerings within these categories,
Right.
driving additional growth.
All right, so they're not just coasting on essentials.
Yeah,
They're finding ways to innovate even in traditionally stable categories.
exactly.
Next up, fabric and home care also posting a 3% gain.
Okay.
I'm sensing a pattern here. Is this possibly linked to the nesting trend we saw during the pandemic?
Mm-hmm.
As economic uncertainty rises, are people staying home more, leading to increased demand for laundry detergent and cleaning supplies?
I think it's a compelling theory. Consumer behavior is heavily influenced by economic sentiment. When people feel uncertain about the outside world, they often retreat into their homes,
Yeah,
leading to greater use of these types of products.
that makes sense. Finally, we come to baby, feminine, and family care.
Right.
This is the strongest segment, showing 4% growth.
Oh, wow.
But here's where things get really intriguing. Baby care itself is actually down. What's going on here? Is this the declining birth rate we keep hearing about?
Yeah.
Or is there something else at play?
Declining birth rates are definitely a factor. Fewer babies mean less demand for diapers and other baby products.
Right.
But it's not the whole story. Increased competition in the baby care space, with new brands and innovative products hitting the market, is also putting pressure on P&G.
So it's a combination of demographic shifts and competitive dynamics.
Interesting. Okay, we've covered the sales breakdown, and we're starting to see a more nuanced picture of P&G's performance. It's not just about overall growth, but about understanding the underlying trends and potential challenges in each segment.
But now the big question, is this growth profitable? That's where things get really interesting.
Yeah, that is the million-dollar question, isn't it? Top-line growth is great, but if it's not translating into profits, then it's not really sustainable. So let's dig into P&G's profitability and see what we can uncover.
First up, the gross margin.
Mm.
It's actually down both reported and currency neutral. And this is despite the report highlighting productivity savings. What gives? How can they be saving money, yet seeing their margin shrink?
It's a classic, I think, case of multiple forces at play. P&G is facing some headwinds from rising commodity costs. Think of all the raw materials that go into their products, everything from oil for plastics to pulp for paper products.
Yeah.
Those costs have been increasing, and that's squeezing their margins.
So it's not just about internal efficiency, it's about external factors they can't fully control.
Exactly. And then there's also the issue of product mix. They might be selling more units overall, but if a larger portion of those sales are coming from lower margin products, that will drag down the overall gross margin.
So maybe they're pushing promotions on certain products to drive volume, even if it means sacrificing a bit of profit per unit?
That's a possibility. And we can't forget about reinvestment. P&G is pouring money back into the business. Research and development, new product launches, marketing campaigns,
Right.
all aimed at driving future growth. And these investments do impact margins in the short term, even if they eventually lead to higher profits down the road.
It's a delicate balancing act, squeezing out profits today while also planting seeds for tomorrow.
Let's move down the income statement. SG&A expenses, those are selling general and administrative costs, are up, even on a core basis.
Okay.
Is this tied to those reinvestment efforts you mentioned?
Absolutely. Higher marketing spend, expanding sales teams, these are all part of their growth strategy. But it does raise the question, are these investments generating a sufficient return?
Right.
Are they getting enough bang for their buck? It's a gamble, isn't it? Spending big in hopes of even bigger returns. All right, let's look at the bottom line operating margin. The reported number is up significantly, but that's because of that large impairment charge we discussed earlier.
Right.
The core operating margin, which is what we should really focus on, is actually down. This is a crucial takeaway for listeners.
I agree. I think this tells us that P&G's profitability is under pressure, despite that top-line growth. It's not a crisis yet,
Right.
but it's something they need to address if they want to maintain their attractiveness to investors.
So they're growing, but they're not necessarily becoming more profitable.
Yeah.
Now let's talk about what they're saying about the future. What does their guidance tell us?
Well, they've maintained their sales growth range of 2% to 4% overall and 3% to 5% organically.
Okay.
This suggests they're confident about continued growth despite those headwinds we've discussed.
Aren't these just projections? They don't have a crystal ball, do they?
Of course not. There are many assumptions built into these forecasts. The global economic environment could worsen consumer spending, could soften competition, could intensify. Lots of things could throw them off course.
Speaking of risks, the report explicitly mentions some headwinds they're anticipating. What are those?
Well, they're expecting a $200 million hit from higher commodity costs, and now a $300 million impact from unfavorable foreign exchange rates.
Wow.
On top of that, there's another 10 to 12 cents per share headwind related to those one-time items we discussed earlier.
Wow, so there are some serious challenges ahead. This makes their maintained EPS guidance even more intriguing. They're still projecting 10% to 12% growth in diluted EPS, but again, that's off a deflated base due to last year's charge. The core EPS growth projection of 5% to 7% is more realistic, but still.
Yeah.
Considering those headwinds, it seems awfully optimistic.
It does raise an eyebrow. It's possible they're being overly optimistic, hoping to project confidence to investors, or perhaps they have some tricks up their sleeve. Cost-cutting measures, price increases, new product launches.
Right. That they haven't fully revealed yet.
So there's potential for a pleasant surprise if they outperform, but also a risk of disappointment if those headwinds prove stronger than they anticipate.
Exactly. It's a game of wait and see.
Yeah.
Now, P&G is known for its robust cash flow. Let's dive into that aspect and see how it's holding up.
They reported strong operating cash flow of $4.8 billion and adjusted free cash flow productivity of 84%, and they returned almost $5 billion to shareholders through dividends and share repurchases.
Wow.
This highlights P&G's commitment to rewarding shareholders even amid these challenges.
Absolutely. They're a cash-generating machine. But the question is, how sustainable is this level of shareholder return given all those headwinds.
They've maintained their adjusted free cash flow productivity guidance of 90% for the year
Okay.
and expect to pay out around $10 billion in dividends and repurchase $6 to $7 billion worth of shares. That's a lot of cash out the door. Are they being too generous, or are they truly confident in their ability to keep the cash flowing? It's a high-stakes bet. They're clearly banking on their ability to navigate these challenges and maintain strong cash generation. But if those headwinds intensify or their growth falters,
Right.
that level of shareholder return could become unsustainable.
So it seems like P&G is walking a tightrope, balancing growth ambitions with profitability pressures while also trying to keep investors happy with generous cash returns. It's a complex juggling act.
Indeed. And amidst all this, there's one more point I want to highlight. The report mentions constructive disruption as part of their strategy.
Yeah.
What does that even mean in the context of a company as established as P&G? Are they truly innovating, or are they simply trying to play catch-up in a rapidly changing world?
That's a great question. Are they disrupting themselves and their industry?
Yeah.
Or are they being disrupted by external forces and just trying to keep pace? It's a crucial distinction.
It is, and it's something I think listeners should consider as they evaluate P&G's long-term prospects.
Right.
Are they proactively shaping the future of their categories, or are they simply reacting to market shifts?
All right, we'll leave our listeners with that thought-provoking question to ponder. This deep dive has revealed that while P&G's surface might gleam with decent growth and shareholder rewards, there are some underlying cracks and uncertainties that investors need to consider.
Yeah, it's like they're this giant ship trying to turn in a narrow channel. It takes time and effort, and maybe a few scrapes along the way.
I love that analogy.
Yeah.
So to wrap things up, it seems like P&G is facing a real balancing act here.
Definitely. They're juggling that need for consistent growth in a mature market with the pressure to maintain profitability
Right.
amidst rising costs and, that economic uncertainty. And they're doing all of this while trying to keep shareholders happy with those generous dividends and buybacks.
It's a tough spot to be in.
It is. But let's not forget, P&G is a seasoned player. They've been navigating these complex markets for decades. They have a vast portfolio of iconic brands, a global reach, and a history of innovation.
So you're saying it's too early to count them out?
Exactly. This earnings report has revealed some vulnerabilities.
Right.
But it's not a sign of impending doom. The question is, can they adapt quickly enough to the changing consumer landscape, manage their costs effectively, and find new avenues for growth?
And can they do all that while continuing to reward shareholders at the current level? It's a lot to ask.
It is, but that's what makes following a company like P&G so fascinating.
Yeah.
The stakes are high, the challenges are real, and the outcomes are uncertain.
I love how you frame that. It's not just about numbers on a spreadsheet.
You're right.
It's about strategy execution.
Yeah.
And ultimately about the company's ability to adapt and evolve.
Yeah.
This has been a truly insightful deep dive. Any final thoughts for our listeners before we sign off?
I just encourage everyone to remember that an earnings report is just one data point. It's important to view it within the broader context of the company's long-term strategy, the competitive landscape, and the overall economic environment. Do your own research. Connect the dots and form your own conclusions.
Excellent advice. Don't just take our word for it. Dig deeper and think critically. And on that note, we'll wrap up this deep dive into P&G's second quarter earnings. Thanks for joining us on the Daily Earnings Reports podcast. Don't forget to like and subscribe, and we'll catch you on the next episode.